Okay, hello once again, everyone. My name's Elliot Yu. It's Thursday, December 7th. It's just after 7 o'clock here on the East Coast. I'm as I said, I'm the editor and co-founder of Energy and Income Advisor. And we're actually get started with the webinar right now. Webinar title, of course, Energy's Goldilocks Wave. And I put here on this first slide, and I'll throw this up at the end as well. If you'd like to see more about some of the themes we cover in tonight's webinar, this website, which I just put up this morning, includes a pretty lengthy article covering a lot of the points I'm going to cover in tonight's webinar. There are some points that I'm covering in tonight's webinar that aren't on that website. There are some things on that website that won't be covered in tonight's webinar due mainly to time constraints. So that is a good website to check out if you want to hear more about the kinds of themes we're talking about tonight. That is our service email address, service@capitalisttimes.com. We will have a question and answer session at the end of tonight. You might think of something later on that you'd like to ask, or if you didn't get your copy of the slides, you should have, but if you didn't, just give us an email on that email address. And finally, of course, that's our toll-free number, which is available from 9 a.m. until 5 p.m. here on the East Coast, if you'd like to give us a call. Just real quick, here's our agenda for tonight. And a lot of these things were covered on the invitation as well. A lot of these points were covered on the invitation as well. We're going to talk a little bit about the energy price cycle. All markets, not just energy, but pretty much all markets are governed at least partly by an overarching cycle. Cycles of demand, supply, and price are the primary drivers of commodity cycles like oil. We're going to talk a little bit more about that, and also a little bit more cycle. Second point, I'm going to tell you what exactly I mean by the Goldilocks wave, why this is the most profitable part of the energy cycle, sort of the cycle for energy stocks and master limited partnerships. We'll talk a little bit about that. Why the master limited partnership structure isn't broken. You've probably heard this a lot lately. It's been on the news. It's been on a lot of websites. A lot of pundits out there are sending out promotional emails around this idea that the MLP or master limited partnership structure is broken. Look, I've been covering this particular sector for almost 20 years now, and I can tell you that I've heard that this structure is broken at least half a dozen times over that 18-year, 19-year period. And every time it's been untrue, and it's turned out to be a great buying opportunity. I don't think this time is any different. What I will say is that the MLP structure is broken. The bears are right in some cases. There are certainly some MLPs where the structure is broken. However, it's not true across the board, and that's a big mistake a lot of investors are making. We'll also talk about how I derive my upside targets for energy stocks. We're looking for gains of a little over 40% in energy broadly through 2019. And in some cases, 50% plus out of some MLPs. How do we derive these targets? I know they sound pretty aggressive, but actually, I think they're actually a little on the conservative side, and I'll tell you why. Also, we'll talk about some specific profit themes and stocks that we're recommending right now, as well as some names we're recommending avoiding. The last bullet point here is a response to a number of emails I received before tonight's call. And that's about why was oil down so much yesterday? It was down 3+% yesterday if you're looking at West Texas Intermediate. And there's a lot of competing rationales for why the price of oil was down yesterday. I want to tell you what I think the real reason is for oil being down so much yesterday. It did rebound a little bit today, but I wanted to address that question as part of my prepared remarks because it's been asked of me so often over the last 24 hours or so. And finally, of course, we will open tonight's webinar up for a question and answer session. Ask me anything you like. If you want to ask a question, either drop it to me in the chat box on your screen or the Q&A box on your screen, and I will get to those questions as soon as I finish the prepared remarks from tonight's webinar. So that's just a little overview of our basic agenda for tonight. And of course, we will have a Q&A section at the end. I will try to move through all these slides as quickly as possible because I do have to. And one more housekeeping. This webinar is being recorded. You should have already received a link to the slide presentation a couple hours ago by email. However, this webinar is being recorded in its entirety. I will send you the recording as soon as it's available, which will probably be tomorrow morning. As soon as the recording has been rendered, we'll send you out a link where you can listen to it at your convenience, at your leisure. The first chart here is one, and it's based on data that's put out by BP, which is the old British Petroleum, of course. The inflation-adjusted price of oil going back to 1861. So this goes back to just a couple of years after that first oil well was drilled. The first commercial oil well was drilled in the United States, in Pennsylvania, Oil Creek, Pennsylvania, back in 1859. So you can see this is, again, this is not the nominal price of oil. This is the inflation-adjusted price of oil in 2016 dollars, and it's an annual average. And you can see that, you know, oil prices have always been cyclical. There have been several large bull and bear markets in oil going back to 1861. However, I think you can actually divide this environment up into two parts. You have the part before about 1970, and you have the part after 1970. Prior to 1970, before OPEC really started flexing its muscles. OPEC was created in 1960, but didn't really start manipulating the global supply of oil until the early 1970s. And the big change between if you will, the first three quarters of this chart and the second three quarters of this chart is a big increase in volatility. And generally speaking, the average price of oil has been higher since 1970. The inflation-adjusted price of oil in 2016 dollars for this entire period from 1861 all the way up until 2016 is $35, around $35, a little under 35 US dollars, 2016 dollars per barrel. Since 1970, it's closer to $55. It's a little under $55. So OPEC flexing its muscles has caused the price of oil to be generally higher and more volatile. You can see in particular, there's that big spike in oil in the 1970s. And of course, there's a more recent big spike in oil that peaked out in 2008, which was in July 2008 when WTI got up to around, that is West Texas Intermediate crude oil got up to around $150 a barrel of crude. However, it's clear there have been several cycles in oil over this time period. The other point that I'd want to bring up is that the average price of oil in 2016, i.e. last year, was around $43.75 a barrel. And that's the last data point on this chart. And you can see that's under the post-1970 average price of oil. This year, the average price of oil is well over $50 a barrel. And of course, right now, it's more like $56 or $57 a barrel if you're looking at WTI again. And that is actually slightly over the long-term average price of oil since 1970. So even though it may seem like the price of oil is low, you got to remember that you're probably thinking about that in reference to where oil was trading 10 years ago in late 2007 and 2008, or even 3 years ago in 2014 when it was trading over $100 a barrel. It's actually pretty high. The price of oil is actually pretty high if you look at it on an average basis since 1970. So we move on from there. This chart here is the basic cycle chart for oil prices that pretty much holds for all time. And the way you interpret this chart is this. And I kind of like to think of this as a clock face to make it easier. So 12 o'clock, noon would be the top of this cycle. 6 o'clock would be the bottom of the cycle. Of course, 9 p.m. or 9 o'clock would be the left-hand side of this cycle, and 3 p.m. would be the right-hand side of the cycle. And what it is that there are really three factors that go into a commodity price cycle. There's supply, there's demand, and there's price, and they're all related. So if you look at the upper right-hand side of this cycle chart between 12 o'clock and 3 o'clock, this is when prices are still relatively high. I mean, the price of oil is relatively high, but has begun to fall. Now, at this stage of the cycle, because the price of oil is still relatively high and has been high for a while at the top of the cycle, you're seeing two effects on supply and demand. On the supply side, you're seeing relatively strong supply growth, and that's because companies have spent a lot of money on exploration and development to take advantage of those high commodity prices. So supply growth is pretty strong. At the same time, demand growth is probably pretty weak, and that's because when prices are high, people want to consume less oil. So you have demand destruction. So those two factors, rising supply, shrinking demand, which are both related to price, cause the price of oil to fall. Rising supply, weaker demand tends to push the price down. Eventually, you get into sort of that orange segment of the chart between 3 and 6 o'clock. And at this point, the price of oil has fallen pretty far. And what you start to see is that because the price of oil has fallen so far, companies are spending a lot less money on exploration and development, and that means supply growth is relatively weak. At the same time, lower prices begin to encourage more demand for oil, and eventually that brings us to 6 o'clock on this chart, and the price of oil starts to rise again. You get in that blue segment, the price of oil starts to go up again. You still have, though, the lagged effect of all that lost investment during that low price period. Therefore, supply growth is relatively weak. Demand growth is still pretty strong because price of oil is still relatively low. And eventually we get back up to that green segment and sort of start the whole cycle again. And one of the things that I think is very important to understand is that there's a view out there that the price of oil and the price of energy stocks are directly correlated. They're almost like two sides of the same coin. That's the thought process I think a lot of people have. In other words, the price of oil goes up, price of energy stocks goes up. Price of oil goes down, price of energy stocks go down. That is certainly true at certain stages of the cycle. However, one of the sweet spots of the cycle is actually not that green segment on the cycle chart, but more like the blue segment, sort of between 6 p.m. and 9, if you will, 9 o'clock. That blue segment, getting into the first part of the green segment perhaps, when the price of oil is just high enough that it's not so high that it causes demand destruction, but it's not so low that it means that energy companies can't make money. So you really don't want the price to get too hot, because if the price of oil gets too hot, it encourages excess supply growth because everybody can make money at $100 oil, whether you have terrible acreage in the middle of a very weak return shale field, or if you have prime acreage in the Permian Basin. It doesn't matter at $100 a barrel that much. All those people can make money. So you really don't want oil to be so high that everyone can make money, because you're going to have too much supply growth and you're going to have demand destruction. And ultimately that's going to lead to this cycle restarting. At the same time, obviously, if the price of oil is too low, nobody makes money and energy stocks perform poorly. So the Goldilocks stage of the cycle, if you will, is that price, that sweet spot of a cycle, that price point where price is neither too high nor too low. So you don't have either massive demand destruction and excess supply growth, or prices so low that nobody can make money. This sweet spot, this Goldilocks price, does change over time. It changes over time for many reasons. For example, is the global economy very, very strong? If it is, it can probably handle a higher price of oil and not see demand destruction. What's technology like in the industry? In other words, if drilling efficiency is getting better, if companies are able to produce more oil for a lower cost, if service costs are relatively benign, then they can handle a lower price of oil without and still make money. And therefore, if the price of oil gets above that sort of range, they can start to grow their production and overwhelm the market with supply. So it does change between periods. I would say that a few years ago, it was probably up around $80 a barrel. But because of the gains in shale efficiency that we've seen over the last few years, in other words, these companies can produce more oil with fewer rigs. They're paying less to drill a well because they're getting faster, better. They're drilling more productive wells. I would say the break-even price, the sort of sweet spot Goldilocks price for oil right now, is somewhere between $55 a barrel and $60 a barrel. That's a level that's comfortable for everyone in terms of West Texas Intermediate. Your better producers can certainly make money at that price, but it's not high enough to see sort of runaway U.S. shale production growth. You'll definitely see some shale production growth, but not runaway growth like you might see at $70 a barrel. At the time, it's not so money and do well and produce profits, produce free cash flow, as I'll show you a little later on in this webinar. But it's not so high that you get runaway shale production growth or massive demand destruction. Of course, that's an estimate. Of course, it could change over time with changes in technology or the global economy. But right now, I'd estimate that's about the sweet spot. The good news is I think that oil prices are likely to range around there. I think on an average price basis in 2018, next year, you will see oil in that $55 to $60 range for WTI and the $60 to $65 range for Brent. I believe it's quite possible that you will see spikes on either side of those ranges. You might see a spike, for example, in WTI up towards $65 a barrel, Brent towards 70, and you might see a downside spike in WTI towards 50 and Brent towards 55, but I don't see those be long-lived. I think those are going to be relatively short-term spikes. We're going to in that Goldilocks range for energy, which is $55 to $60 a barrel for U.S. oil prices. And I'll show you a little bit later on one of the reasons why I have this relatively constructive, if you will, outlook on crude oil. Now, I wanted to show you a prior cycle, an example of what's happened in the past to prove to you this thesis that stable oil prices, less volatile oil prices in that Goldilocks range is actually the sweet spot of the cycle. And I want to take you all the way back to 1988. And let's even give you a little backstory from before 1988, which is that in the 70s, energy prices were really, really high. As you know, OPEC started flexing its muscles. Oil prices quadrupled in 1 year in 1973, in fact. But they remained relatively high, over $100 a barrel on an inflation-adjusted basis back in 1980. Supply began to overwhelm demand in the early 1980s, mainly because those super high prices, those too hot prices at the end of the 1970s, caused excess supply growth by the early 1980s. Places like the North Sea of Britain and Norway, the North Slope of Alaska and Mexico all saw very rapid supply growth because high oil prices encouraged exploration and production and a big surge in output. So we saw that in the late 70s, early 1980s. The price of oil began to come down. And what happened was Saudi Arabia, mainly, said, okay, to keep the price of oil up, we're going to reduce our own production to offset the growth in production from elsewhere around the world. So they managed to soften the decline in oil prices, but by 1985, that became untenable. Their production, Saudi production, 70% from where it was in 1979, 1980. And they just couldn't keep up producing so little oil because even though they were propping up the price, the reduction in volume was causing a big hit to their overall revenues. So in December 1985, the Saudis came out and said, no more, we're going to produce more oil and we're no longer going to prop up the price of oil. Price of oil collapsed 70% in a matter of 3 months, 70% in a matter of 3 months, to a low in 1986. Then it began to see a gradual recovery because lower oil prices caused increases in demand, and they also pretty much brought to an absolute standstill any growth in global oil production. By 1988, things had stabilized into sort of a Goldilocks range of price. So on a nominal basis, I'm saying in historic dollars, not in inflation-adjusted dollars, the price of oil basically ranged between about $15 a barrel and $30 a barrel, $27 a barrel, for most of the period from 1988 until 1998. On the period on this chart, that gold line that you see on this chart is actually the price of West Texas Intermediate crude oil. So you can see in 1988, it began in the $16 range and ended this period in September of 1998. It ended this at around $1 higher than that, up around $17 a barrel. So over that 10-year period, the price of oil was basically flat. It increased about $1 over that 10-year period. There was one spike, which happened in the early 90s around the time of the Gulf War, the first Gulf War. But as you can see, it was very short-lived, and the price of oil immediately came back down into that sort of range that it had been in for most of this period. So the price of oil was absolutely flat. Most people look back on the 1990s as being a period where energy prices, but that blue line shows you the performance of large energy companies that existed back then and still exist to this day. It includes names like Exxon, Chevron, Schlumberger, the big oil services company. Those are just 3 of them. I looked at 14 in total, and I created an equal weighted index. And as you can see, over this time period, that equal weighted index was up almost 500%. So the price of oil was flat between 1988 and 1998, but these energy stocks were up almost 500% over that time period. It even beat the S&P 500 in one of the best markets in history for the broader stock market, despite the fact oil prices were pretty much flat. And that's because when the price of oil is relatively stable at sort of a comfortable level, where it's not too hot and not too cold, you know, the old story about Goldilocks and the 3 little bears, right? Goldilocks went for, you know, the porridge that was neither too hot and not cold. Same thing with the price of oil. Not too hot, not too cold. Energy stocks can do phenomenally well, just like they did over this 10-year period back in the late 80s and through much of the 1990s. Now, if we look at today, there really are 2 components, if you will, of the Goldilocks wave that I like to look at. The first is that, what's the commodity price at? Well, is the price of oil at a range where a lot of companies can make money, but it's not so high that you're going to see excess supply growth or demand destruction? As I said, I think that's where we are right now in this $55 to $60 a barrel level. And again, I will show you later on some of the fundamentals I look at to determine that, or at least 1 or 2 of them. And they're more on that website that I'll throw up again here at the end. But one of the things that the second part of the Goldilocks wave, if you will, is actually the valuations of the energy sector as a whole. And there are many, many ways to value the energy stocks. And I look at about a half dozen on a regular basis. This is just one of them, but I think it's one that's pretty interesting. And what it is, there are 11 official sectors within the S&P 500, 11 official sectors. IT, consumer discretionary, consumer staples. Energy is just one of the 11 sectors in the S&P 500. And what this chart shows is the weight of energy stocks within the S&P 500. In other words, do energy companies in the S&P 500 account for 5% of the index, 15% of the index, 20% of the index? I can tell you, for example, right now, the largest sector in the S&P 500 is information technology. Technology stocks account for almost 1/4 of the S&P 500, which is the highest in history except for a period from late 1999 to early 2000. Technology has done very well. It's very much an in-favor sector right now. In contrast, energy has a near record low weight in the S&P 500 right now. Energy stocks account for 5.9% of the S&P 500 right now. That is up from about 5.6% in August, but it's well down from 16+% just a few years ago in 2008, and up around 15% as recently as 2010, 2011. So the energy's weight within the S&P 500 is now back to the same level about the same level as 1998, when the price of oil was just over $10 a barrel, and back in 2002 when the price of oil was under $17 a barrel. So energy's weight in the S&P 500 shows that it is way below normal. Now, if you look at this chart right here, you'll see these 3. The gold line is energy's average weight in the S&P 500 going back to 1990, and that number is about 9.3%. So on average, energy accounts for about 9.3% of the S&P 500. That red line is 1.5 standard deviations above the mean. Standard deviations is just a measure in statistics of how far a sequence, an index like this, deviates from its average value. And that green line is 1.5 standard deviations below that average line. And as you can see, there have only been 3 times in history that the energy's weight in the S&P 500 has been 1.5 standard deviations below that mean of 9.3% of the S&P. That was, again, late 1998, early 1999. Again, in late 2002, early 2003. And just over the last few months. In the summer, it dipped below that 1.5 standard deviation lines. Now it's about, it's a tiny bit above it, but it's pretty much right there. Only 3 times in history that energy's weight has fallen this far relative to the S&P 500. So that tells me right there that energy is very much out of favor. If energy stocks were just to rebound to an average weight in the S&P 500, in other words, back up to 9.3% of the S&P 500, that would translate into returns well over 50% for the S&P 500 energy index. I'm not predicting that. I do think that it may take a long while for us to get back up to that average level. But I do think you could get back up to the level we saw back in 2000 or so when it rebounded off those 1998 lows, where it gets up to about 7.5 to 8.5% of the S&P 500. And that would translate into gains of around 40% from the current level, not from the summer's lows, but from the current level. I think that's actually a pretty conservative expectation for what could happen to energy. It's very unusual to see both of these factors happen at the same time. In other words, it's very unusual to see energy be so cheap at the same time that oil is settling into that Goldilocks range I talked about. It really has only happened a few times in history, and this is one of them. And typically, you see very strong returns when those two elements line up. When you have both cheap valuations and comfortable oil prices, you can see explosive gains. I think 40% by the end of next year, by the end of 2019 rather, almost next year, is quite conservative, if anything. What are some of the indicators I look at in terms of the tightness or lack thereof of the oil market? Well, one of the things I like to look at is the shape of the futures curve. Now, this is an interesting thing, and that's that, you know, if you listen to amateurs, if you listen to financial journalists on TV or in many places on the internet, et cetera, there's a lot of talk about the price of oil. So the price of oil went down $1 or went up $1 today. The price of Brent oil, maybe the price of West Texas Intermediate crude oil or some other benchmarks, the price went up, down today, tomorrow. And mostly these people are looking at the price of oil on a spot basis, in other words, for immediate delivery, or more frequently, they're actually looking at the front month futures. So in other words, the futures that's closest to the present times in terms of a delivery date. So for right now, that would be the January 2018 WTI or Brent oil futures is pretty much what's being quoted. That actually, I mean, of course that's important, but it's not the most important thing to look at when it comes to oil. It's when you listen to professionals talk about oil, when you listen to people who trade oil or companies, you usually hear them talk about the shape of oil, not the price of oil. And what do I mean by shape? Well, the futures market is a market where you can contract for delivery of oil at some point in the future. So for example, right now, I could buy a January 2018 future, which would allow me to buy oil for delivery in January next month. Or I could buy oil for delivery in January 2019, a year from then. Or I could buy oil at any month in between those dates or any month in the future all the way out until the early 2020s if I want to. And so these two lines on your chart illustrate the price of oil for delivery in each month using this is based on actual futures market data going out until the early 2020s. Now that gold colored line that you see there, that's the current price. Actually, that's as of the December 6th close, yesterday's close, of Brent oil The current price, as of yesterday's close, the price of Brent oil for delivery in January was a little over $61 a barrel. And if we look further out in the future, the price of oil is actually lower. So in other words, if you go out to say 2022, you see the price of Brent crude for delivery in 2022 is closer to $56 a barrel. So the price of oil today is higher than the price of oil in the future. This is called backwardation. Backwardation. The blue curve is the Brent oil market curve exactly 1 year ago on the 6th of December 2016. And what you can see there is that the price of oil for immediate delivery a year ago was about $54 a barrel, and the prices rose in the future months. This is called contango, when you have an upward sloping curve of this nature. So the current futures curve for Brent crude oil, which is the key international oil benchmark, is in backwardation. The curve a year ago was in pretty steep contango 1 year ago. So what does this mean? Well, if you think about it, the general rule of thumb is that bears want contango and the bulls want backwardation. Backwardated crude oil markets tend to be bullish, and bears like to, if you will, dance the contango, right? So contango is bearish. Now, why is that? Well, a lot of it has to do with storage. So in other words, in the current market, there is no value for storage. Storage actually has a negative value. Why is that? Well, why in the world would I want to, in looking at the current curve, which is the gold curve on this chart, oil is trading for around $61.50. Brent crude oil is trading for $61.50 right now. Why in the world would I want to take oil that's worth $61.50 today, put it in storage, and then sell it a year from now at $58 a barrel? You're losing money the longer you store oil. So a backwardated curve tells all market participants something. It's a price signal, which is the basics of capital of any market. There's a price signal here, and what that price signal is telling me is sell your oil right now. If you have oil in storage, take it out and sell it right now. That's because the price of oil today is higher than the price of oil in future months. Another way of looking at that is the futures market is telling me that right now there is not enough oil in the global market. The supply of oil is less than the demand right now. And so the futures market, by being in backwardation, is basically saying we need more oil right now, which is why the price today is higher than the price in future. There's a premium for immediate delivery. On the opposite case, a year ago, the price of oil, the futures market curve for oil was in contango. And that encourages storage because the price of oil today is lower. So a year ago, I could have bought Brent oil at $54 a barrel, stored it for a year, and sold it for $58 a barrel or $57 a barrel. So there's an advantage to storing oil when the market's in contango. And the market's telling me when it's in contango, there's too much oil in the global market right now. So that's what we mean by the shape of the oil futures curve. The important thing to remember, and over the last 3 years, we've been pretty consistently bearish in oil prices until the last 6 months or so, 5-6 months or so. And the reason that we said that every single rally from late 2014 all the way up until this summer was sort of a false dawn, one of the main reasons was that the Brent oil market and the WTI oil market never came out of contango. They always stayed in contango, even when the front month price was rising. The market retained that upward slope. And what that told me is that the rallies were not for real. When the rallies are for real, then it should be backed up by a tightening supply-demand situation. And the fact that the oil market was still in contango, even when the price was going up, told me, just looking at that one number, that the fundamentals of the oil market were not keeping pace with the rallies, with the technical oil market. That all changed this summer when Brent began to flip into backwardation as the price of oil went up. That told me that finally we're seeing the supply-demand situation for crude oil rebalance. So just looking at this one simple indicator, you can get an idea of what the market is telling you the current supply-demand balance is. I think this is extremely useful, particularly because there's so many alternate opinions out there. You'll hear you know, the IEA, the International Energy Agency, says one thing about supply and demand conditions. The EIA, the U.S. Energy Information Administration, says another. OPEC says a third thing. And then there are all kinds of private forecasters out there as well saying all sorts of different things about supply and demand. I care more about what the market is telling me. And this chart right here tells you what the market is saying. Traditionally, best forecaster of all, really. So if we flip here to the next chart, I want to talk a little bit more about the relationship between the index and crude oil. And I think that the common perception is that they're two sides of the same coin. In other words, they always move in lockstep. Oftentimes that's true, although as I said, in certain stages of the cycle, in particular the Goldilocks wave stage of the cycle, energy stocks typically outperform crude oil. That was certainly the case between 1988 and 1998, which I showed you a few slides ago. But let's look at sort of a more normal environment. This is a chart that shows two different indexes. The one line, the sort of orange colored line there on the bottom, is the price of Brent crude oil. So that's the spot price of Brent crude oil. That black line you see on your chart is the S&P Oil Exploration and Production Index. It's an index of a bunch of energy producers ranging in size from, you know, Exxon Mobils and Chevrons of the world all the way down to some of your smaller independent U.S. shale producers. And you can see from 2014 all the way through 2016, when the price of energy was mainly falling for most of this period, the prices of oil and energy producers moved pretty much in lockstep. Over this entire period, the price of oil, in fact, was down about 11% or about 10.6%. And the price of the price alone return of the S&P Exploration Production Index was down about 10.5%, a little under 10.5%. So pretty much moved in complete lockstep. This year, however, has been totally a different story. The price of oil, if you look at Brent this year alone, in 2017 alone, is up about 11%. It's up 10.7% right now. Yet the return on energy stocks is actually down about 16%. This is a very wide divergence, as you can see, particularly since June all the way up until the present time, since the June lows for oil. There's a very wide divergence between the performance of oil itself, the commodity, versus energy stocks. A very big divergence between those two. This is very unusual. It is not a record divergence, but it's close to it. And I think it represents something very important, which is a change in what investors want out of energy companies. In particular, what do they want out of energy producers? Back a few years ago, the best performing energy stocks were typically the energy companies that could grow oil production the fastest. So back in the 2011 through 2014 period, for example, energy companies that were able to grow their oil production the fastest typically did the best in the stock market. So Wall Street was rewarding, if you will, growth and avoiding companies that had stagnant production. Lately, though, the focus has shifted much more on returns. So the idea is that investors no longer want companies just to grow production for the sake of growing production. Companies that can spend within their cash flows, in other words, their capital spending on going out and drilling new wells, on building out pipeline capacity to handle all their production, that spending is covered by the amount of money they actually generate from producing oil and gas. So they're spending within their cash flows, yet still generating some production growth and having some free cash flow left over after all that capital spending to pay dividends or buy back stock. So I want to look just to kind of, and this is something we hear from more and more management teams lately. There was a conference just a couple of days ago where a number of different energy producers said basically this: they were focused more on returns, shareholder returns, than on production growth, which is a big shift from what was the case even a year ago. This is a big shift in investor sentiment towards the sector, not rewarding growth, wanting free cash flow. So on this chart, I have three lines. The one line is that S&P Exploration Production Index that I showed you previously. That is the orange line. The black line is a company called Apache. The symbol is APA. And the dotted black line, or sort of grayish black line, is actually Occidental Petroleum, symbol OXY. Now, as you can see, there's a wide variation of performance here. This is on a year-to-date basis alone. Occidental is actually up slightly. It's up about 1%. The S&P Exploration Production Index is down, as I said, about 15.8% this year. And Apache has done far worse than that. It's down about 35%. The problem with Apache is that they're not they have to spend a lot of money to even maintain their production, and they're not showing any production growth despite spending all this money. For example, in 2017, this year and next year, Apache's total capital spending is going to be about $3.1 billion. A lot of Apache's production growth is coming from an area of the southern Delaware Basin that they call the Alpine High Play, Alpine like A-L-P-I-N-E, High Play. It's a very promising field. They've identified about 3,000 to 4,000 potential drilling locations there, and the wells are quite productive. But there's one major problem with these wells, which is they produce an awful lot of natural gas and natural gas liquids and not very much oil at all. So they're producing low-value natural gas, not a lot of oil. Out of those 3,000 or 4,000 total drilling locations that they've identified in the Alpine High Play, only about 500 are really oil-focused locations. So they're going to spend $3.1 billion next year, and about the same actually in 2019 expected as well. These are early estimates for that, about the same this year. But oil production growth over the next few years is only going to be about 1% annualized. So they're only growing their oil production about 1%, and they're generating relatively small amounts of free cash flow because most of their production growth is going to be on the natural gas and natural gas liquid sides where returns aren't very high. They pay about a 2.5% dividend yield. So they may be able to continue covering that, but you're not going to see a whole lot of growth in return on capital because, again, they have to spend a lot of money to generate relatively light production growth. So if we look at Occidental, in contrast, Occidental Petroleum has a number of different production areas, but the one that they're really focusing on right now is also in the Permian Basin. But their plays in the Permian Basin tend to be in places like New Mexico, which is the northern part of the Delaware Basin, also parts of the central Delaware Basin, and these wells are much, much oilier. As a result, Occidental has said that it can generate about 5 to 8% growth in oil production, even with oil at $50 a barrel. So even with oil much lower than it is today, they can generate 5 to 8% annualized growth in oil production. So they're generating more growth in oil production while spending within their cash flows, even $50 a barrel oil. Yet they also pay a 4.5% dividend yield. So this is a company that is spending within its cash flow, growing oil production, and returning capital to shareholders in the form of an industry-leading 4.5% yield. Compare that to Apache, which is barely spending within its cash flow and generating only 1% growth in production and only yields about 2.5%. And I think you can see the contrast, which explains why Occidental is performing so much better this year than either the overall index or Apache. So these are two names that we currently have an energy and income advisor. Apache we have rated as, and Occidental is one of the top picks for 2018. It's a name that's trading a little under $70 a share as of the close today. And we think it's a good buy at current levels. We're actually just boosting our buy under recommendation for that. That's a name I mentioned on a webinar like this a few months ago at lower prices, but we still do like it today. We think that they may even have the ability to start growing their dividend more meaningfully as we enter the end of next year and into 2019. So that's one of our top plays on the E&P side of the equation, exploration production side of the equation. Now, I wanted to get on to another question that has been on a lot of investors' minds, which is that is the MLP structure broken? Now, master limited partnerships, commonly called MLPs, are a little niche of the energy business. It's kind of a quirky little niche, if you will, of the energy business. These companies were created by the changes in the tax law back in the 1980s. And they are allowed, basically these are traded on the stock exchange just like any other stock. So they're traded on the NYSE mainly, traded just like any other stock. But unlike most stocks, they're not corporations. They're actually partnerships or pass-through vehicles. Pass-through, of course, being a term we've heard a lot over the last couple of weeks with all the back and forth on tax reform here in the U.S. But these companies, what they do is they pay quarterly distributions, which represent earnings, profits that they make, cash flows that they generate, pass through to you and me as investors or unit holders in the MLP. The average MLP in the United States right now yields about 8%. There are certainly many MLPs yielding well north of 10% right now, and some yielding less than that. And I'll talk about one of those in just a second. And they haven't done very well this year. The Alerian MLP index, which is is probably the most widely watched industry benchmark for this industry, is down significantly this year, and has continued to fall despite the recovery we've seen in oil prices and many other energy stocks since over the last few months since August. So what's going on? Well, whenever this happens, and as I said, I've seen this happen at least a half dozen times in my career. There are all sorts of articles out there, including in some, supposedly reputable publications, about how the MLP structure is broken, that just doesn't work, and it's going to go away. And a lot of the MLP is broken arguments center around 2 to 3 basic points. The most important one is that what MLPs typically own is very capital-intensive assets, which are basically midstream energy assets. So this is stuff like pipelines, like natural gas storage, like natural gas processing plants, natural gas gathering lines, individual wells to processing and fractionating plants. So these are pretty expensive assets that require big upfront capital investment, but generate very steady cash flows over time, and are pretty reliable cash flows that aren't sensitive to commodity prices. So the typical MLP model is you go public, and that raises some capital, and you buy or build a bunch of these assets, and you use the cash flows generated by these assets to pay out large quarterly distributions, as well as to help fund more pipeline acquisitions or more pipeline building. Typically, however, MLPs do take on debt and issue additional units of stock to raise capital, issue additional units of the MLP to raise equity capital to fund acquisitions and growth. So one of the big knocks against the MLP structure, and this is absolutely nothing new, this has been true since the 1990s, going back to the 1980s even, that MLPs are reliant on outside capital. In other words, they have to borrow money or raise money by share issues to fund growth. And again, that's been true since the dawn of time, but every time MLPs perform poorly, it's something that comes up. And the second part of it is that over the last few years, a lot of MLPs, the bears would argue, MLPs have seen a big jump in debt. So they've taken on a lot of debt to fund growth, but they've also bought assets at inflated prices. They've paid too much to build assets that just aren't generating enough cash flow. And as a result, the model has become impaired. They can't grow because they can't raise capital cheaply enough or fund growth cheaply enough to continue paying out or growing their distributions. The fact is that there are many MLPs for which that is very true. A lot of the MLPs that are the worst, in our opinion, are those that have come public over the last several years, because a lot of these names were brought public to take advantage of the fact that investors wanted yield. They wanted dividends. They wanted income. And so a few years ago, it was quite possible to put a bunch of odd assets that didn't have much growth potential into an MLP structure, list it on the stock exchange, and get a nice big fat valuation for it. And many companies did exactly that. You know, Wall Street's famous for supplying to demand, right? However, that doesn't mean all MLPs are the same or that all MLPs are in the same boat. For example, on this chart, I'm looking at the debt to earnings before interest, taxation, depreciation, amortization for 3 different MLPs in my coverage universe. 2 of these MLPs we rate sell, and 1 of these MLPs we rate a buy right now. I think it's an excellent name. And I look at this going all the way back to 2001. And you can see that MLP on the top is Newstar. Newstar is an MLP that actually used to be part of Valero way back in the day. Newstar is a company, an MLP that we have not been very impressed with the prior management team. I think the new management team is a little better. Newstar is a company that has, over the years, gotten involved in purchasing a lot of bad assets. They own these asphalt refining facilities that turned out to be, they bought from the Venezuelans actually, that turned out to be a very bad deal for them. They have had and still have assets in the Eagle Ford shale play of South Texas, which is just not very economic and at current oil prices. They are making some positive changes, building assets into more attractive areas. But I mean, I think the argument that a lot of bears make that they have too much debt is probably pretty much on the mark. I mean, if you look at this chart, you can see, back in early 2009, they had a debt to EBITDA ratio of around 4 times. Now it's over 6 times. That's sort of the high end for the industry. If you look at the bottom pane of the chart, that's Plains All American. Plains All American is another large MLP that's been around for many years. For many years, we considered it one of the best in the industry. But look at how much their debt to EBITDA ratio has creeped up over the years. Back in 2013, it was around 3 times. It got all the way up to 8 times in late 2016, early 2017. And one of the ways they brought it down since is by slashing their quarterly distribution to unit holders a couple of times over the last 1.5 years or 2 years. So they've had to cut their distribution to retain more capital to help pay down their debt. And that's a name that we think has some challenges ahead of it. But look at that middle pane. This is an MLP called Magellan Midstream Partners, symbol MMP. It's a name we like a lot on a long-term holding basis. Their debt has been pretty steady at around only 3.5, 3.6 times EBITDA for several years now. Because MMP has been very disciplined about what they invest in. They have invested in a lot of projects that we think have stable long-term returns, such as pipelines connecting the very prolific field, the Permian Basin, to markets on the U.S. Gulf Coast. This is the kind of pipeline that's always going to have stable demand. They have long-term contracts in place. They don't have a lot of commodity price sensitivity. This is an MLP we think you can buy. It has gotten sort of dragged down with the rest of the industry, but unlike these other 2 MLPs I'm showing you my chart here, they don't have a debt problem. So that argument that a lot of the bears are making against the MLPs just doesn't apply to MMP. There are certainly MLPs which have taken on too much debt in recent years. Newstar and Plains are 2 examples. MMP is not, as you can clearly see on this chart. Newstar, as I said, is broken over the long term. I took this chart all the way back to the end of 2005, and this is a total return from owning Newstar over this period of time, 2005, all the way up through the present time, and all the way up through the end of November. And you can see that on an annualized basis, it's up about 49%, almost all of that, and then some is dividends. That's only about a 3.4% annualized return on the stock. One of the problems that they've had is, again, as I said, they issued a lot of equity, they took on a lot of debt, and they bought a lot of bad assets. But that certainly isn't the case with Magellan Midstream Partners, which you can see on this chart. Magellan Midstream Partners, over exactly the same time frame, is up 685%. And this was one of the largest MLPs back in 2005. It's still one of the largest MLPs today. Newstar was one of the larger MLPs back in 2005. It's still a large MLP today. But you can see that MMP has raised capital in a disciplined fashion. They've raised debt and equity capital in a disciplined fashion. They maybe haven't grown as fast as some of the other MLPs out there at times, but their steady Eddie approach has produced low debt and steady distribution growth over time, and the stock 5%. The problem I think many bears make, the mistake that they're making, is by lumping all the MLPs into that one category. mainly high-profile MLPs this year, which have cut their distributions, Plains being one of them, Energy Transfer Partners being another one, Genesis LP being a third one. A number of them have cut their distributions over the last couple of years. Magellan has not. It won't, in our view, because their distribution coverage is very high and they own high-quality assets. So when looking at the MLPs of all the energy sectors I cover, the difference between the names that are well-positioned and the names that are poorly positioned is the widest of any sector I cover. So while I look at the overall valuation of MLPs versus, say, other income-producing assets, and it looks to be near 20-year lows in terms of valuations on the basis I look at, that would imply, a 20, 25, or 30% upside for the group as a whole. I don't think that's going to be at all even. I think you will see some MLPs up 50% plus over the next 2 years, and you're going to see other MLPs that are flat to down to up slightly. And a lot of it's going to have to do with quality of assets, their debt position, their distribution coverage, and their ability to grow without spending a lot of money to raise capital. So these are all factors that we look at in evaluating MLPs. As I said, MMP is an example of a name we like. Newstar is an example of a name we don't like and would recommend selling right now. The final question I think I promised on that opening slide, and then I'll open up the floor to your questions, is the real reason that oil prices declined yesterday. And, I heard all sorts of stuff. Obviously the fundamental rationale and what catalyzed the big sell-off in oil prices was the oil inventory report released by the Energy Information Administration yesterday. And it showed a much larger than expected decline in the amount of oil in storage, which would normally be bullish for oil prices. But it showed a much larger increase in inventories of refined products, gasoline and diesel fuel, distillate fuel. So that was taken as a big negative because one of the main drivers of the upside in oil over the last several months has been strong demand for diesel fuel and strong demand for gasoline over the summer months in particular here in the U.S. So the price of oil did sell off, sort of catalyzed by that. But I think that I think if you look at it that myopically, if you look at it, you're kind of missing the entire forest for the trees, right? So the real reason that the price of oil went down yesterday is because the price of oil has gone up a lot in the last several months, and hedge funds in particular, but hot money traders, institutional traders, have bet heavily on a big rally in oil prices. They are making a lot of money as a result. When you buy a lot of oil futures and the price of oil goes up a lot, you make a lot of money. And a lot of these guys are looking for a reason to lock in those gains, to take some profits off the table. And this chart really tells you that that's going on directly. This is a chart that comes from what's called the Commitment of Traders report. And in this case, it's the one released by the Intercontinental Exchange in London for the Brent oil futures market. And this chart shows the black line there is the net position by hedge fund futures traders in the Brent futures market. So when that black line is rising, it indicates that hedge funds are adding to their long positions in oil futures. And when it's declining, it indicates that they're taking money, that they're selling oil or going short oil, or some combination thereof. That gold line is just the price of oil over the same time period. So you can see from the end of 2014 all the way up to the end of 2017, you had a few periods where the long position in Brent oil futures ran up a lot. For example, in the first 4 or 5 months of 2015, and then it began to sell off. And shortly after, the hedge fund positioning began to turn. If you look kind of on the left-hand side of the chart there, maybe I can actually add some lines here to better illustrate what I'm talking about. Yes, but if you look here, see if I can get this to draw for me. Well, doesn't seem to be working for me today, but basically, if you look here on the left-hand side of the chart, you'll see that in April and early May of 2015, the positioning in the Brent oil futures market was around almost 300 million barrels long oil, and that was up from around 100 million barrels at the end of 2014. So hedge fund traders were betting on a big rise in the price of oil, and that did happen. The price of oil jumped from under $45 a barrel all the way up to over $60 a barrel by June, late May and June of 2015. And they took profits on those positions, and you can see the hedge fund positioning coming back down to about 150 million barrels long, and the price of oil plummeted as a result. So there was a very close relationship there. And in fact, if you looked at the commitment of traders report and the hedge fund positioning, it actually led the price of oil a little bit. The same happened in early 2016. You saw a big jump in the hedge fund long positions from the beginning of 2016 all the way up into March or April. And then the hedge funds began liquidating their positions, and the price of oil stopped going up shortly thereafter. So there's been a pretty close correlation over time between the hedge fund position in the oil futures market and the price of oil. In particular, when hedge funds have a really long position, in other words, they're betting heavily on the price of oil going up, that's often a good time to consider cutting your positions in oil because it makes it vulnerable to profit taking. Those hedge funds are looking to take some money off the table and lock in some of their gains in the oil futures market. On that basis, the thing is right now that in the Brent oil futures market, hedge funds are long a record 540. So hedge funds are long more oil in Brent. They're betting more heavily on a rally in oil futures than ever before in history right now. So you can see why that makes the market right now, which you can see on this chart, very vulnerable to profit taking from time to time. Because the price of oil has run up a lot. Hedge funds have bet heavily on a price of oil going up. They're making a lot of money. We're nearing the end of the year. That makes the market vulnerable to bouts of profit taking, such as what we saw yesterday. That, I believe, is the real reason that oil prices were down so much yesterday. Nothing sinister going on fundamentally. You know, inventory data is very volatile from week to week. So to say that this was a big turning point in the inventory data is completely ridiculous. It's normal around the holiday season in particular to see a lot of volatility in inventory data. What we saw yesterday is nothing at all unusual there. At the same time, I would also say that I look at this commitment of traders report every week. It's something I've talked about a lot over the last few years. However, in a bull market for oil, which we're kind of transitioning into right now, big spikes in hedge fund long positions do tend to lead to bouts of profit taking, but the price reaction tends to be less extreme than what we've seen over the last few years. This chart shows the same two series. The price of oil is in gold there on that chart, and the hedge fund position is that black line. And you can see that between early 2012 and the end of 2014, the price of oil was pretty constant between $100 and $115 a barrel or so. Yet hedge fund positioning went all over the shop. It got really excessive in early 2013, then it came down again, then it spiked up again in September of 2013, and then it came sharply lower again, and then it spiked up into the summer of 2014. And those first two spikes in particular when hedge funds began liquidating their positions, because the underlying supply-demand conditions were strong anyway, the price of oil only came down a few percent. So I think that that's what you're looking at here. You're going to see some corrections in oil, especially because the hedge funds have such large profits to lock in, but you're not going to see a collapse in oil prices. One more point I wanted to bring up, and this is also in response to some questions I've had. There is a relationship between the energy price cycle, which I've talked about a lot tonight, and the overall stock market cycle. So we're right now, this bull market started in 2009. So pretty soon we're going to be entering the 10th year of the bull market, which would make it one of the longest bull markets in history. This expansion, this economic expansion, is also one of the longest in history. I don't see any signs at this point that we're anywhere near a recession. In fact, I see the opposite. I see not only the US, but also Europe and Japan seeing accelerating economic growth right now. So I don't think we're about to enter a bear market at all. But I think it's fair to say that we're probably pretty late in the cycle. I would be surprised if, for example, we didn't see a recession in the U.S. sometime between next year and 2020, the next couple of years. It is a long bull market. It is a long expansion for the U.S. economy. We're getting near the normal lifespan of one of these cycles. So I'd be surprised if we weren't nearing the end of the cycle. At different stages in the cycle, early in the cycle when the U.S. is just coming out of recession, the market's just coming off a low. The middle of the cycle, kind of when growth is sort of humming along, not really accelerating, not really decelerating. And then late in the cycle, when you often see a burst higher in the market, but eventually slowing economic growth. Different sectors perform best at different stages of the cycle. Now, I don't have time tonight to go through all the sectors that have performed best at all different stages of the cycle. But I can tell you that energy is known as a late cycle winner. So if you agree with me that we're in the final stages of this bull market, that we're within, say, 24 months of a top for the S&P and of the U.S. sliding towards recession, then this is a great time to own energy stocks. And look just the last two cycles here. And what I did is I looked at the last year of the economic expansion, at the last year of the bull market, rather, in the S&P 500. In 1990, the S&P 500 topped out in March 2000. So I went back to March 1999, and I also took the first 6 months of the bear market. So in this case, up to September of 2000 for that 1999 to 2000 cycle. In 2007, the S&P topped out in October 2007. So I looked at returns for all of the S&P 500 economic sectors from October 2006 all the way up through March of 2008. So I'm looking at the final 12 months of the bull market and the first 6 months of the ensuing bear market, if you will. And you can see that in that 1999 to 2000 cycle, the energy index was up 29.9%, the S&P up 4.8%. And in the 2006 to 2008 cycle, energy up 48%, the S&P up 3.6%. So energy does tend to perform best in the final year and a half or so of an economic cycle. I do think that if not already in it, we're nearing that. And that also is another reason that points to owning energy stocks. Energy and Income Advisor is our flagship publication. I'm going to open it up now here in just a second for questions. But before I do that, I want to say that we've opened up, again, a special offer for our Energy and Income Advisor folks newsletter. We cover everything from MLPs, Master Limited Partnerships, which I talked about tonight, to energy producers, to foreign energy firms. Roger Conrad and I co-edit this one. We are offering, normally we have a 30-day risk-free trial offer. We've extended that for this month to a 60-day risk-free trial offer. We offer two different subscription options. We offer a quarterly option at $194 a quarter, again, with a 60-day risk-free trial. So over the next 60 days, you'd see 4 issues of the service. We have a couple of, I think, pretty exciting issues coming up. We have an issue on our year-end strategy issue. We have an issue on electric vehicles coming up. And we also have an issue that we just posted to the website a couple of days ago on oil services stocks. We think there's a lot of opportunity there. Both subscription options come with 5 premium reports. And we have probably our most popular feature is once a month. We have what are called our Q&A chats, or monthly chats. And what this is a little different than what we're doing tonight. It's not a webinar where you hear my voice, which you're probably tired of hearing by about this time. But these are online chats where you go and you type your questions into a website. We'll send you a secure link for that. You type your questions on the screen. We see them and answer them in real time. By we, I mean me and my colleague, Roger Conrad. So ask us any question you like about the economy, the market, or individual oil companies and MLPs, and we will answer your question in the order they come in, right live on the chat. We do answer all questions that we receive. We've had these chats last many hours to make sure we answer all the questions on those Q&A chats. With this 60-day trial, risk-free trial offer, you would actually be able to participate in the next 2 monthly chats. One will be towards the end of December and the next towards the end of January. I would say that we are, the quarterly billing option, I am committed to keeping a quarterly billing option for Energy and Income Advisor. I think that's important. The problem is it costs us a lot to manage that, in the sense that, we've all had our credit cards breached in various data breaches. All you have to do is shop at a retailer, and occasionally their data is stolen. Somebody sends you a new credit card. So keeping up with, we have a customer service team of manager Sherry, but we don't use a call center of that nature. So when credit cards are declined, for example, because your numbers change or expiration dates change, Sherry has to follow up to get the new details to renew the subscription. And, doing that every quarter is kind of time consuming and expensive. So we are in our end of year budgeting process right now, and we are planning to raise the quarterly subscription rate from $194 to at least $249. It may go as high as $299. However, if you respond to this offer through the website that I'm going to show you again here in a second, not only will we extend the $194 quarterly subscription rate, however, it comes with a forever guarantee, which means that no matter what the future price of Energy and Income Advisor is on a quarterly basis, you'll always pay that $194 a quarter, regardless of what any future price hike might be. So if it's $299 next January, you'll still pay $194 every time you want to renew, for as long as you choose to remain a subscriber. So your price would be frozen. If you want to do that, if you want to lock in that rate, we are offering a 60-day free trial on that quarterly rate at that lower $194 a quarter. On the annual option, we are offering for a limited time a special bonus, which is a 1-quarter free subscription to our Deep Dive Investing publication. It's our newest publication. It's proven to be extraordinarily popular. It is delivered in a series of online presentations covering our favorite sectors and stocks. We have model portfolios for income, model portfolios for growth, and it covers a wide variety of sectors outside energy, but also including energy. And if you choose our annual option, we are offering, again, for a limited time, a 1-quarter subscription to Deep Dive Investing, which we normally charge $599 for. So those are the offers we have now. They are only available through the website that you see there on the screen, that HTTPS energyincomedvisor.com/energy Goldilocks wave. That website also includes a lot of the charts and a lot of the analysis that I presented to you tonight on this webinar. So if you want to read more, there's also some other details and more specifics that I didn't have time to cover tonight on that website. If you're interested in subscribing to Energy and Income Advisor at the special rates and with the special bonuses I just mentioned, please subscribe through that website. That's the only way that you can guarantee that you get those prices and the extended free trial and everything else. So make sure you use that website and not just subscribe through the link on our homepage if you want to make sure you get all the bonuses I just mentioned and the forever guarantee. Alternatively, if you want to order by phone, feel free to call a toll-free number, which is on your screen. If you do that, Sherry is available between 9 a.m. and 5 p.m. Eastern Time. Make sure you quote to her Goldilocks charter to make sure you get all of the bonuses, extended subscription that I mentioned tonight. So with that, I'd be happy to open up the floor right now to questions. So if you want to ask a question, just type it in the chat box on your screen or the Q&A box on the screen, and I will try to answer as many of them as I possibly can tonight. And if you can't think of a question now, but think of one later, feel free to drop us an email at service@capitalisttimes.com. So I'm going to pause for about 20 or 30 seconds now to have a drink of water and rest my voice for a second, and then I will answer all the questions that come in as they come in. All right, hello again. This is Elliot again. Just took a little pause there to give you a chance to type in your questions and also for me to have a glass of water here. So I'll go ahead and get started answering the questions. The first one I see here is from John. He asks, what is your outlook on Schlumberger? Symbol there is SLB. Schlumberger is, of course, one of the largest oilfield services companies in the world. They are one of the, I guess, what you would call the big three now, which would be Schlumberger, Halliburton, and Baker Hughes, which is now Baker Hughes General Electric. Weatherford is also kind of considered in the top, well, big four, I guess it would be in that case. We like Schlumberger from a long-term perspective, especially down here in the low 60s area, low $60 a share area. They are mainly known for their international business in the sense that they do a lot of work outside North America. They do a lot of deep water, for example. They do a lot of work in the Middle East and Africa and places like that. It's an extremely well-run company. Always has been. Actually, their prior CEO, Andrew Gould, was a legend, if you will. And their new CEO, Paul Kibsgaard, who's Norwegian, is fast becoming one. I think they made some excellent moves early in this downturn, recognizing that it was going to be a major downturn, cutting their costs, right-sizing their head count, if you will, their workforce, and maintaining their margins and really pushing back on taking any business just for the sake of taking business that wasn't going to earn them a good return on their investment. So I applaud them for that. The one thing I would say, and we do like it long-term at current prices, I think it's a good name to own. The one thing I would say in the shorter run, the short to intermediate term, is I think it's going to take a little bit longer for that international business to really pick up off the low. International business tends to be a longer cycle type business than the U.S. in the sense that it takes a little longer for international markets to respond to price. I think Schlumberger is the best placed outside the U.S. of any of these names. I do think, though, that you may see more upside in Halliburton of the big services companies over the next 6 to 12 months, because I think institutional investors are going to be focused on the recovery in North American pressure pumping margins and North American margins related to producing shale fields. And I think that's going to show the most growth over the next 12 to 18 months. So Halliburton is a name that I think is very interesting down here at current prices. It's sort of basing here after having fallen a lot earlier this year. We actually had a sell on that name for a long time, but now that it's come down so far and it's kind of basing down here on the charts, they're starting to show a little uptick in their business and their margins. I think that would be a kind of my go-to name, if you will, for the next 12 to 18 months. Long-term holding, it's hard to beat Schlumberger. Next question I see here. Oh, it's a comment. Thanks for these webinars. Great webinars. Well, thank you for saying that. We enjoy giving them. The next question here, how will the proposed new tax laws affect MLP financials? Well, first of all, there's two versions of the tax law out there right now. There's the House version and there's a Senate version. And of course, those two have to be reconciled. And then the same bill has to pass both the House and the Senate in order to become, and then be signed into law by President Trump in order for there to be any tax reform. There are some differences between the two bills, but actually what's interesting is that the House bill does actually allow MLP unit holders to take advantage of, so let me just back up and explain a little bit in broad strokes how the tax law for MLPs works. So corporations have previously been paying corporate tax on their earnings at the corporate level, and then they pay a dividend to you and me. They pay those earnings out as dividends to you and me, and then we pay a qualified dividend tax rate on earnings from a corporation. So in order to figure out the tax rate on the corporate, you have to add the corporate tax rate, which has been very high up until if this tax reform is passed in the U.S., and then add in whatever your qualified dividend tax rate. Under the new law, of course, the corporate tax rate would be dropped probably to 20%. I mean, I've heard lately maybe there could be a little upside to that, 22%. So if nothing else changed, right, and MLPs are taxed differently. MLPs don't pay any corporate tax, and pass through their income to you and me, and we pay a tax-deferred individual rate on that. So in other words, if you're in the top income tax rate, then you're paying 39.6% right now federal tax on the income that you receive. It is tax-deferred because a large amount of the distributions you receive from MLPs are considered a return of capital by the IRS, which means you're not taxed until you sell the MLP. So by deferring taxes, that does give you an advantage, but the ultimate tax rate on a lot of what you make is going to be income tax rate. So if the corporate tax rate were cut and there were no change to MLP tax structure, then it would close some of the tax benefits of owning an MLP versus owning a corporation, because the corporate tax rate comes down, and then you get to pay that lower qualified dividend tax rate on the dividends you receive from the corporation. Of course, you get no tax deferral advantages, but your tax rate would come more in line with what an MLP pay, what you would pay from getting distributions from an MLP. But that's not what's happened. The House bill actually allows individual investors to use a special pass-through tax rate on passive income paid by MLPs. The House bill has a 20% tax rate on pass-through incomes paid by MLPs. Then it went to the Senate, and the Senate bill originally had no such benefit. So in other words, there was no special pass-through rate available to holders of MLPs in the Senate bill. But at the very last minute, on Saturday morning or very late on Friday night before the bill passed the Senate, the Cornyn Amendment actually added that in. So under the Senate bill now, you will actually be able to take advantage of the lower pass-through tax rate, which I believe in the Senate bill is 23%, on passive income paid by MLPs. So whichever version of the tax reform goes through, there will still be an advantage to receiving income from an MLP versus receiving from a corporation. So the long and short of it is that your overall tax rate from receiving dividends from a corporation versus receiving income from an MLP, the gap there, the advantage for MLPs, is pretty much retained whichever version of the bill passes through. With these tax laws, I tell you, one thing I like to do is you go online. I mean, this stuff is so esoteric and so Byzantine, if you will, in terms of, what's exactly in these bills. I mean, these are really long bills. There's stuff, that was added at the last minute. The best resource I know of is to just Google the MLP Association, MLPA. It's basically a lobbying body for the MLP industry. And typically, if there's some sort of new tax law proposed that's negative, they'll post an awful lot of information on it on their website. And if it's not, then they usually just sort of post positive stuff. So lately, they just kind of congratulated the House and Senate on passing the tax reform laws. And after the Cornyn Amendment was added to the Senate version of the bill, they actually came out and wrote this thing saying, thanking the Senate for recognizing the importance of retaining the tax advantages for MLPs. So to make a long story short, the answer to your question is that the proposed new tax laws won't really affect, will not change the fact that MLPs have a major tax advantage over corporations. And depending upon what the final reconciliation looks like, most people, especially people in higher income tax brackets, will probably pay less on their distributions from MLPs than they do now in terms of the percentage. Next question is, the Senate's version of the proposed tax bill removes the advantage of forming MLPs. If Congress passes their version of the bill, do you think there will be a huge sell-off in MLPs? Yeah, well, I mean, I just kind of went through that, but actually that's not true. The final amendments to the Senate bill actually did add in a tax break for MLPs, passive income. The thing about this is that a lot of people ask about this, but at the end of the day, there's not much of an advantage for taxing MLPs at a higher rate. I think the congressional the body that assesses these things calculated that over 10 years, the cost of allowing MLP unit holders to get this lower pass-through tax rate is only around $700 million, which in the context of, a $1+ trillion tax bill, that's a sort of a drop in the proverbial bucket, 700 million. And they did actually include that in the final version of the Senate bill as part of a sort of last minute amendment. Also, do you think this will lead to the merging of the general partner with a limited partner? Which side is going to get the short end of the stick? Well, I think you're going to see more and more of GP and LP mergers anyway. The reason being is that the way MLPs are structured is that every MLP basically has two parts. There's a general partner, or GP, and a limited partner, or LP. Typically, when you buy an MLP, you're actually buying limited partner. And the limited partners get the distributions, and they also, but they don't actually manage the assets of the company. Those are tasks done by the general partner. In exchange for that, they pay what's called an incentive distribution right to the general partner. And typically those IDRs, or incentive distribution rights, are based on the distributions paid LP holders. So I know that sounds complicated, but it's really pretty simple. The more you get paid as an LP holder, the more the general partner gets paid. The problem with that is, at first, that makes an awful lot of sense because it incentivizes management to keep boosting the distribution. The higher the distributions go, the more the general partner receives. So it incentivizes growth in distributions for the LP unit holders. However, at some point, and the LP's been around for years and years and years, those incentive distribution payments become so large, they affect the overall MLP's cost of capital and ability to grow. And that's when you get to a problem. And typically, what's happened in the past, some of the more forward-thinking MLPs, like Magellan, which I mentioned earlier, Magellan Midstream Partners, Enterprise Products Partners being another one, already eliminated IDRs and eliminated the general partner entirely. Others have taken longer to get to that point. And if the longer they take, the higher their cost of capital goes, the harder it is for them to grow. The problem, of course, is that sometimes when you have to buy out the general partner, then you have to cut the limited partner's distributions because it's so expensive to buy out those incentive distribution rights in the general partner. But I do think you'll see more and more of this. And for some MLPs, it's going to be good news. And for others, it's going to be bad news. But generally speaking, I'd say that the names that we like are strong enough to be able to do these deals, if they haven't already, without cutting their payouts. Some of the weaker names, it's going to be a bigger problem. So it's definitely something we look at. But first of all, I don't see the tax law changing that at all. And in many cases anyway, the general partner is not separately traded from the limited partner. There are obviously some exceptions to that, like energy transfer, equity, and energy transfer partners. And in the cases where there is a separation, it really depends on the company. For example, with energy transfer, which is, by the way, a name we haven't liked at all, Energy Transfer Partners is a name we definitely don't like. If you look at the CEO of this whole energy transfer family, is this guy named Kelsey Warren. He owns the general partner, Energy Transfer Equity, he owns a much larger stake in the general partner than he owns in the limited partner. So that pretty much tells you, right, that the company is going to be run for the benefit of the general partner. So, I would say, as has been the case, the general partner is probably going to outperform the limited partner in a name like that. But that's certainly not always the case. There are cases where I think the limited partner is a better bet than the general partner. So it's very much a case-by-case basis, and I don't see any change whatsoever in that structure due to any of the tax reform that we see. Next question: what's my current outlook and recommendations for NLink, ENLK, and Enterprise Products Partners, EPD? Enterprise Products Partners, one of the larger and better run MLPs out there. It's a name that we've liked for many years. It's pulled back. It could pull back a little bit more, but generally speaking, anytime you can get Enterprise Products Partners with a yield of 7% or more, it's a really good bargain. And that's been the case a lot lately. Anlink is a name we've liked. We've kind of cooled on it in the short run a little bit, though I think on the long haul they're going to be just fine. Yeah, I would say that if you're looking for a kind of, I guess, similar name with exposure to some of the same acid basins, in particular in Scoop and Stackfield of Oklahoma, I would look at Enable instead of Enlink right now. Next question, is this your MLP-focused publication, or is that a different newsletter? We actually cover, we used to, Roger and I used to work for another publisher in the past. We had a separate newsletter that only did MLPs. That coverage universe is all part of the newsletter I'm talking about tonight, Energy and Income Advisor. We cover all the publicly traded MLPs out there. And usually within a quarter or so of a new MLP coming public, we'll add coverage of that MLP. So we have buy, sell, hold ratings on a table on the website for all of the publicly traded MLPs out there. And we cover all of them. We write a lot, often, usually at least once every other month or so, a pretty detailed issue on MLPs and their current outlook. So yes, this is a publication where we cover MLPs. What are my thoughts on Buckeye, single BPL? It's a name we like. It's been really hit over the last few months, mainly because I think that a lot of investors are thinking they may have to cut their distribution next year. Our read is a little different. We don't think they're going to have to cut their distributions next year. So it's a little higher risk than, say, a Magellan, which I mentioned on the call today. But I think it's a good company, which we have a buy rating on. Next question. Thanks for your time this evening. Could you comment on Delek Logistics and Enbridge? No problem. I enjoy doing these. Goldilocks Logistics is a name I like. I would say that the biggest risk there is that if they have to issue equity to fund some of their growth projects. However, I think that's a pretty steady Eddie MLP, and any dips down to under 27 would be a screaming buy on a name like that. It is kind of lightly traded, so in the very short term, I think it's going to be kind of volatile, but when you're talking about a name with a 10% yield that has probably 10% annualized growth in its distributions ahead of it. Enbridge, in contrast, is not a name we like. Just not impressed at all with management team there. Next question, opinion on PBA, that's Pembina. My colleague Roger Conrad is a Canadian midstream company. My colleague Roger Conrad covers a Canadian company at great depth in Energy and Income Advisor. I must confess I'm not as familiar with them as he is. I do know, however, that he generally likes Pembina. I just don't know as much about the company as he does. You might want to ask him for a more detailed opinion. Generally speaking, though, they own pretty steady assets which are governed by long-term contracts. And so, like a lot of the big U.S. MLPs like Magellan, they don't have a lot of exposure to commodity prices, and they should be able to hold and grow their distribution over time, and that's the recipe for strong performance in my view. Okay, let me see if there's any more on the chat function here. Okay, well, on the chat screen here, I noticed that Sherry, our customer service manager, has posted a link to all my slides tonight. So if you, for some reason, didn't see that, you can just click that link there, and there's a slides to presentation. Question here is, what's your outlook on Schlumberger? I actually did answer that. It's basically long-term positive, and however, in the short to intermediate term, I think Halliburton's probably a better play. Symbol there is HAL, and that's a name we recently wrote up in the publication. Next question, how do you get the deep dive investing publication only? Well, we recently closed down the charter membership offer for deep dive, in the sense that we had been offering at a reduced price and offering a 60-day free trial. However, for anybody who's on the webinar tonight, I will go ahead and extend that to you if you'd like to try deep dive investing. We're offering it as part of that charter membership at $299 a quarter or $999 a year, and it does come with a 60-day money-back trial. And so if you'd like to check that out, the easiest way is to give our customer service manager, Sherry, a call at that toll-free number on your screen there, 1-877-302-0749. Tell her that you were on the webinar tonight and that you're interested in deep dive, and she will make sure you get that special charter rate. The price of it has gone up for regular members to deep dive as of, I guess, last week, the beginning of last week. But since you're on this webinar, I'll go ahead and extend it to you. Just tell Sherry that I offered that to you here on tonight's webinar. Next question I see, actually one I covered, I think, just a minute ago. How will the proposed new tax laws affect MLP financials? Not really much at all. The House and Senate bills, as they stand, allow MLP unit holders to take advantage of a special pass-through tax rate, which I believe is 20% under the House bill and 23% under the Senate bill. It is a little more complicated than that, but that's the basics. And of course, we don't know what the final bill is going to look like. It depends upon what comes out of the reconciliation between the House and Senate versions of the bill and what ultimately gets sent to the president's desk. But I would say that when the MLP Association, which is the industry lobbying arm, isn't worried about it, then I'm not usually worried about it. They're very, very quick to jump on top of writing something up on their website about anything that could be used. And the final version of the Senate bill did include an amendment which allows investors to receive that lower pass-through tax rate on MLP distributions. And so let me see if there's any more questions here. I mentioned enable. What's the symbol? Symbol for enable is ENBL. ENBL. And next question I see here, will the complete presentation, including Q&A, be posted? Yes. It takes some time, a few hours, for the presentation to render in terms of that we can post it up on the website. But as soon as it's available, which will probably be tomorrow morning sometime, probably around the time the market opens, we'll shoot you an email with a link that will allow you to see the full webinar presentation, recorded version, as well as this Q&A. And if you want the slides, they are available. You should have received a link by email. Also on the chat box on your screen, you should also see a link that you can click that will allow you to download these slides in PDF format. So that's all the questions I see on the screen at the moment. But if anybody has any more questions, I'll give you another minute, another 30 seconds or so. Just type it into the Q&A box or the chat box on your screen, and I'll answer any more questions that you might have. I know it's getting close to 8:45 here on the East Coast, so many of you may be about ready to get off this webinar. But if you have any more questions, I'd be happy to answer them. And I'll just give you about 15 seconds here or so to see if any more pop in. All right, it looks like that's it for tonight. So thank you all very much for participating in tonight's chat. Appreciate all the questions and also your time and this evening. Once again, if you have any questions that come up after the conference or after the webinar, or if you, for example, listen to the presentation recorded tomorrow and something pops up, feel free to drop us an email at that email address on your screen, service@capitalisttimes.com. If you're interested in our special offer for Energy and Income Advisor, including the 60-day free trial, the free 1/4 subscription to Deep Dive Investing for annual members, and also our reduced rate for a limited time for quarterly members, please go to the website on your screen, energyandincomeadvisor.com/energy-goldilocks/wave. And you can actually see a lot of the charts that I talked about tonight. A lot of the analysis and commentary I gave tonight is actually on that website in written form. Some stuff I covered tonight, not there. Some stuff there, not on tonight's webinar, but it's a pretty good summary. Also, that's the only way, online anyway, that you can make sure that you get all of the bonuses and all of the extended trial period and everything else I talked about tonight, including that free subscription to Deep Dive. Alternatively, if you'd prefer to order by phone, not a problem. Give us a call on that toll-free number on your screen, 877-302-0749. It is open 9 a.m. to 5 p.m. Eastern Time. But please quote the Goldilocks Charter offer code when you talk to Sherry. You don't need to put an offer code in on that Energy Goldilocks Wave website. That automatically will give you all the free reports. But if you want to order by phone, make sure you quote that code to Sherry to make sure you get all the bonuses I talked about. And with that, I will close down tonight's webinar. Thanks again for everyone for attending, and look forward to welcoming you as subscribers.